All right. So, okay. So this is chapter 18, clip number 2. I'm continuing my discussion on the IMF, World Bank, Bretton Woods, which is in your textbook, as I said. Page, I think it was, what did I say it was? It was 611, 612, and 609. So that's stuff. Again, okay, so I think I done enough on the World Bank. It was basically, it was set up for reconstruction of destroyed economies after World War II, and also to help colonies sort of modernize and liberalize their economies and infrastructure building, so that they're more than just locations to take natural resources and export them, so they can actually modernize and develop. That was the plan. Now, okay, so that's the World Bank, or now the IMF. Again, New Hampshire. Again, that Bretton Woods stuff. It was part of its sort of mandate was basically to encourage full employment, right? As I discussed somewhere else, full employment means the non-accelerating inflation rate of unemployment, the NAIRU, the natural rate of unemployment, whatever you want to call it, which of course does not mean zero unemployment. It just means that there is no cyclical unemployment. So the only unemployment that exists is that frictional and structural unemployment that was discussed in chapter 2 of your textbook. Okay, so this is that unemployment where people, let's say just got their degree and they're searching for a new job. That's frictional. And structural is like, the jobs in the city are require one skill set, but you have a different skill set. So you're unemployed because you have to, look for a new job in another city and then move and relocate and so on. So that was part of the reason why we had the IMF. The other one, of course, is price stability. What was interesting is that part of this whole deal was that it was to establish circumstances, actually, under which current countries were allowed to lower the value of their currency. This is that devaluation. That was on page 609 of your textbook. And also to set the circumstances in which a country could raise the value of its currency, called the revaluation of its currency, also on page 609 of your textbook. And so this is what is in effect called an adjustable peg rate system. Right, remember I talked about, you have the free market solution for supply and demand in the foreign exchange market. If you just let the market do the exchange rate determination, what boils down to price determination, right? Because remember, exchange rate is the price for foreign exchange, right? How much does it cost to buy $1 US? Then that is the flexible exchange rate regime. If you go to the other extreme, where the central bank is actively buying and selling foreign exchange reserves, right? In my example, it was the yen, but it could also be the US dollar. Again, I'm speaking from a Canadian perspective for the Bank of Canada. Then it fixes it at some exchange rate at which supply and demand initially are not equal in the foreign exchange market. So it basically deals with those gaps. That's the fixed rate regime. This adjustable peg system is what this Bretton Woods setup basically was. And it's sort of an intermediate case, sort of in between fixed and flexible, sort of in the middle. What it means is that the government are supposed to have fixed exchange rates. So they're supposed to try to keep these fixed rates. So it's sort of like a fixed exchange rate. But it's also sort of like a flexible one, because there are certain circumstances that allow the government to revaluation or devaluation. And so the purpose then of the IMF was actually to act as sort of like the global cop of the exchange rate market, so to speak. It was to approve and basically to approve and monitor exchange rate changes. So to monitor so that countries weren't going off on these revaluations or devaluations. The reason why this was happening was because back in those, as I said, the 1930s, you had these competitive devaluations. So one country would devalue its currency to try to encourage more exports and to create domestic jobs. The other country would see that and retaliate and also devalue. And so it would be devalue, 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 back and forth. It's like I do it to you, and then you do it to me, and then I do it back to you. And so it's sort of like a push, and then you push back, and then it's sort of this kind of spiraling out of control. Right, so a devaluation would lead to another devaluation, which would lead to another devaluation from one country against the other country. And so what ended up happening, of course, is it destroyed all the international trade, right, and didn't create more jobs. Remember, this is, again, during the Great Depression, right, so unemployment was still a problem. National income didn't rise. So that was the whole idea of having this IMF, was to prevent this sort of spiraling out of control devaluation by one country, then retaliation by another. This is just like my game theory clip I made, right? The collective best solution, if you remember my little payoff table, was for free trade by both countries. But when one country devalues, then the other one devalues, and so you end up with that Nash equilibrium scenario where everyone's devalued and everyone's worse off. And that's basically what this beggar my neighbor scenario of the 1930s was. So to prevent that from happening, and to force the countries into that situation where both sides stay with the free trade, and stop them from unilaterally devaluing, that's part of what the IMF was about. The other mechanism to facilitate this will be made in my next video called GATT, the General Agreement on Tariffs and Trade. This was the other tool, and then later replaced by the World Trade Organization, to prevent these kind of unilateral changes, so that both countries stay at the free trade, and preventing these competitive devaluations. Now, the IMF in modern times is a somewhat controversial institution because of how it worked with developing countries. Okay, what was happening was a lot of these developing countries, for reasons pertaining to oil, got themselves into debt. Right? What happened initially was the countries that had to import a lot of oil obviously ran up large debts. And then what happened was some of these exporting countries, because they had made a lot of money because of high oil prices initially, borrowed too much. And then when oil prices went back down, now they have this huge debt and low oil prices. So they also got themselves into problems as well, because now they have huge debts and they can't make tons of money because the price of oil's lower, right? Their exports are cheaper. So the IMF had to sort of act like this kind of intermediary, so to speak, to kind of help out these countries. What they called rescheduling of debt, right? To help them, because they couldn't really pay their debts off, these developing countries. Today, so to speak, at the current time. So they had to sort of help them out by either lending them the interest payments or rescheduling things and so on. Of course, what happened was the IMF then would impose on these countries rules and restrictions, so they couldn't spend a lot of their money on government programs. In other words, the IMF was looking out for the people who lent the money, the big banks, so they get their loans paid back. And so this, of course, became a political controversy over this sort of international institution stepping in and telling us, what our government can and cannot do pertaining to taxes and government programs and so on. So that basically I think we'll leave it at that. And my discussion on IMF and World Bank and Bretton Woods. My next clips I'm going to make are pertaining to sort of kissing cousins, so to speak, the GATT WTO system.